Good evening, everyone, and thank you for joining me for the January 25th, 2023 edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver-Candy, and I'm happy to be here with you tonight answering plenty of questions from our community around student loans and much of the news and the one-time benefits that can get people closer to cancellation. And for some people, they might find out tonight that they're already there. I do want to apologize for being just a little bit late. We're having some technical difficulties with getting the feed queued up to Facebook, but here we are, ready to go now. So I would like to go ahead and share with you all a bit about the Maryland Center for Collegiate Financial Wellness, then a quick note about office hours, and then we will get into the questions from our community, and we have got plenty. So first, I want to share with you the vision for the Maryland Center for Collegiate Financial Wellness. We are helping students and families build financial life skills, empowering them to thrive. Our vision is that all college and career school students in the state of Maryland have the opportunity to achieve these 6 pillars of collegiate financial wellness. First, being creditworthy. Second is ready. Third is resilient. Fourth is empowered. Fifth is successful. And sixth, and finally, is thriving. I won't read all the details, but if you're interested in learning more about the center, our mission and vision, and the work that we do to advance both of them, you can visit us online at mccfw.org. Again, that's mccfw.org. So about office hours. Office hours is our free virtual student loan clinic. It provides borrowers with a trusted venue to help them navigate student loan repayment and prepare for financial success beyond repayment. Now, with office hours, I must say that it's presented for informational purposes only. It should not be construed as financial or legal advice. I do my best to bring you the most up-to-date and reliable information when it comes to student loans, but if you've been watching the headlines, you have probably seen that there's a lot going on and there are many things that are changing. So if you need individual help with your student loans, we can connect, and I can share that link. I can share that link on Facebook in the comments on this video after I'm finished, and you can reach out and schedule a one-to-one session so that we can take a look at your loans. I can make you aware of the benefits that you might be eligible for, and then you can draft a strategy to move forward. But the information that's presented here tonight is presented for informational purposes only. Take it all in, take a look at your personal situation, and then make a decision that's most fitting for you and your circumstances. So with that being said, let's get into our first question of the evening. That question has to do with public service loan forgiveness and what those payment counts mean. So the first question is, the online payment tracker shows that I have -1 payments to make to reach public service loan forgiveness. What does that mean? So when you have negative payments to make, that's actually good news. That means that your loans have met the requirements for public service loan forgiveness because you have at least 120 qualifying payments. But sometimes there's a lag between when you see that your loans have reached more than 120 and when MOHELA notifies you that your loans have reached 120 and your debt has been discharged. So a couple of people asked this question. I had one person who was at 121, another person who was at 123. So the screenshot that you're seeing here is from a person who had -3 payments to go until reaching PSLF. So I just wanted to break down for you what you're looking at when you see the payment summary. So we've got qualifying payments and payments that need employment certification, both listed under eligible payments. And then at the very bottom, you have ineligible payments. The qualifying payments number is what matters when it comes to PSLF, because those payments have been evaluated and they've also had employment to match them that has been confirmed. So your qualifying payments are the ones that have been determined to count toward public service loan forgiveness. The eligible payments include your qualifying payments, but also any periods of repayment that do not have documentation of your qualifying employment. So in the case of this person here, we have eligible payments listed at 184. Qualifying payments are listed at 123. The difference between those two is 61, and those are months where there were payments or periods of repayment logged, but there's no employment to match them. The good thing is that since that number in the qualifying row is more than 120, this person doesn't need to do anything else. There's no need to provide documentation for the other months of employment, even if they were employed in public service. There's no need because that qualifying payment figure is greater than 120. So in the case of this person, when they look at the actual payment tracker, that has 120 going down the middle, and it shows you how many more payments you have to go. They're at -3. That means they've exceeded the requirement by 3 payments, meaning they have more than met the qualifications to have their remaining debt canceled by way of public service loan forgiveness. And I mentioned earlier that there is a lag between when you might log on to your online account, use that PSLF drop-down menu to look at the payment tracker and see that you have more than 120 qualifying payments, and you receiving the actual letter that says you have met the requirements and your loans have been discharged. From dealing with another borrower who just last week we logged on and saw that many of the loans had reached 121. They reached out to MOHELA to ask, how long is it going to take before I actually get word that I have met the requirement and the loans will be discharged? And the response that they received back, and this was early last week, was that the process of discharging the debt and initiating any refund could take up to 90 business days. I italicized the business days because there's a big difference between 90 days and 90 business days. So with this person, we saw that their account had reached 121 payments early last week. We don't know when that figure was actually updated, but the estimate for the time when they can expect to receive official notification that the debt has been discharged could take up to 90 business days. But the most important thing is that qualifying figure is more than 120, and that's what we need to get the debt canceled by way of PSLF. So congratulations are in order for both of these borrowers, one at -1 and one at -3 payments to make in order to achieve PSLF. So they're already there. All right, let's move on to the second question. It is, I have a FFELP loan, but I'm not sure if I should consolidate for the IDR adjustment. What are the pros and the cons? So first, I want to take a step back and just look at the language. FFELP loan, those are older loans, I believe issued prior to 2010. There are 2 varieties of FFELP loans that we'll talk about. Some of them are commercially managed and some of them are held by the Department of Education, but both of them are federal student loans. And this person is wondering whether they should consolidate those loans into the direct loan program so that they can benefit from the IDR adjustment. IDR stands for income-driven repayment. So what are the pros and cons? There are a few things that I would suggest that folks consider when it comes to pondering this decision about what to do. And pardon me, I just realized the header on this slide is wrong. It's still the PSLF qualifying payment counts. But we're actually talking about IDR adjustments and FFELP loans. So the considerations, first, what kind of FFELP loans do you have? Are they commercial or are they the ones that are held by the Department of Education? In thinking about the transition out of the FFELP loans into the direct loan program, I would think about how FFELP borrowers have been treated, especially in the past few years when we've had the COVID-19 or CARES Act forbearance that went into effect in March of 2020, and FFELP borrowers, a lot of them got left behind and had to continue making payments throughout this forbearance that's been going on for almost 3 years now. Also, with the Biden-Harris Student Debt Relief Plan that is looking to provide cancellation of up to $20,000 for federal student loan borrowers, commercially held FFELP loans are left out of this. So for me, if I look back at that treatment, I think I would say, you know what, I don't want to be a part of that anymore if I can get more benefits on the other side, and the other side being the direct loan program. However, the decision to consolidate is a very personal decision. It depends on the types of loans you have, how long you've been in repayment, and what kind of repayment plan you were in. So you really have to think about if you want to switch to what you might be on now, which is a balance-driven plan, into an income-driven repayment plan, because IDR stands for income-driven repayment. The IDR adjustment is going to take a look at past payments or past periods of repayment so that most everyone gets a count to let them know where they are relative to cancellation through IDR. But for some people, they may be closer to paying off those older loans, or if they're not closer, but they switch to an income-driven repayment plan, the payment under that IDR plan might be so much higher than the payment that they're making right now that they say, you know what, it's not worthwhile. So it's a very personal decision. It depends on your loans. It depends on your income. It depends on the type of repayment plan that you've been in. But generally speaking, I would want out of the FFELP loan program. But again, it's a totally personal thing. You have to evaluate your loans and decide if switching to the direct loan program is affordable for you and if it's worthwhile. So in speaking about the loan types, I really wanted to just touch on the differences between FFELP loans and direct loans when it comes to eligibility for relief. So in the first column there, you're going to see different loan types, starting with commercially held FFELP loans, then federally held FFELP loans, then direct loans, and finally private and alternative loans. If you take a look at that bottom row, I want you to notice that it's no, no, and no, because private and alternative loans are not eligible for any benefits that are offered to federal student loan borrowers. Private and alternative loans are loans that were the lender is actually a bank. It's outside of the federal government. So there's no chance that those loans will get relief through the Biden-Harris Student Debt Relief Plan. They are not eligible for the income-driven repayment adjustment. They are also not eligible for public service loan forgiveness. So we'll go back to the federal loans. The first type of loans, the commercially held FFELP loans. These are federal student loans that are held by banks. Unfortunately, they are not eligible for relief through that Biden-Harris Student Debt Relief Plan, which was to provide up to $20,000 per eligible borrower. However, they can be brought into eligibility for both the IDR adjustment and public service loan forgiveness. And if your balance on those types of loans is large enough, it might be worthwhile to consolidate into the direct loan program so that you can have up to the entire remaining balance canceled. Now, remember, it's a very personal decision. It depends on how long you've been in repayment, what your household income looks like, and how much you owe to really figure out if it's worthwhile to take those FFELP loans and convert them into the direct loan program. However, if you do, then those loans could become eligible for the IDR adjustment and for public service loan forgiveness. Next, let's move on to federally held FFELP loans. Federally held FFELP loans are eligible for relief under the Biden-Harris Student Debt Relief Plan. Of course, there's some other eligibility criteria for the borrowers, but federally held FFELP loans were not left out of this plan. They are also eligible for the IDR adjustment. But if you're a person who has worked in public service for a while and you want to get the benefit of public service loan forgiveness, you would need to consolidate your federally held FFELP loans into the direct loan program so that they can become eligible for public service loan forgiveness. And remember, with the IDR adjustment and public service loan forgiveness, what's at stake in terms of cancellation is the entire remaining balance of your debt once you have reached the milestones required by the programs. With the Biden-Harris Student Debt Relief Plan, we're looking at basically a cap. The maximum amount that a person could receive through this plan is $20,000. For many people, that's enough to wipe out their debt completely, but for others, they owe much more. So a program like public service loan forgiveness or the opportunity that's being offered through the IDR adjustment might provide more relief for people who have larger amounts of outstanding debt. Now, let's move on to the direct loans. And with direct loans, you'll see the eligibility for relief is yes, across the board. Yes, direct loans are eligible for the Biden-Harris Student Debt Relief Plan. They're also eligible for the IDR adjustment, and they're eligible for public service loan forgiveness. There is an asterisk there because Parent Plus loans are special. And under normal circumstances, Parent Plus loans, even though they're direct, would have to be consolidated into a direct consolidation loan so that a parent could enroll in the income contingent repayment plan. The income contingent repayment plan is the only income-driven plan currently available to parents, and that plan, payments under that plan would qualify toward public service loan forgiveness if the parent also worked for a qualifying employer. But right now we're in this period of the income-driven repayment adjustment. And within the past month, the Department of Education has come out and said that Parent Plus loans will be eligible to receive credit through the IDR adjustment, and those credits can be applied toward PSLF. So that is good news for parents, and I'm looking forward to seeing many get relief through the IDR adjustment and hopefully PSLF too. So let's take a look at how to verify your loan types, because your eligibility for relief depends on what types of loans you have. So the first question is your loan or are your loans federal or private? To get the answer to that question, you want to log into studentaid.gov. And if you see a balance in there, then that means you have federal student loans. If you see a balance there, of course, you know that they're federal student loans, but you've got to dig a little bit deeper to see what type of federal student loans you have. But first, I want to go back to the difference between federal and private. So if you're looking at federal loans, they'll be inside of studentaid.gov. If they're private loans, you will not see those balances within studentaid.gov. You would have to visit the actual lender or access your credit report. And your credit report should include both your federal student loans and your private student loans. But for those of you who have federal loans, there's a second question to ask, and that is your federal student loan held by the Department of Education, also known as ed-held or federally held loans? Once you're inside of studentaid.gov, you can view your loan servicers. And when you look at the loan servicers, if your loans are held by the Department of Education, you will see the servicer's name listed after Department of Ed. That lets you know that the loans are ed-held. Or if the loans are in default, you'll see Default Management Collection Systems. And an example of that would be with Nelnet. If the loans are federally held, you'll see Department of Ed/Nelnet, and that lets you know you have federally held student loans. It's also possible that you have some that are commercially held and some that are federally held, and different rules apply to each set of loans. All right, so let's move on to the next question. This has to do with Parent Plus loans. And the question is, my daughter still has a balance after grants and loans. Someone told me not to take Parent Plus loans because they are private loans. Which loans should I borrow, if any? That is a loaded question. So first, I just wanted to break down the difference between Parent Plus loans and private or alternative student loans. So with Parent Plus loans, I've heard many people say, well, Parent Plus loans are private, you don't want to borrow those, but that's not actually true. Parent Plus loans are federal student loans that are made available for parents to borrow to help with their children's educational costs. So the lender is actually the federal government. The borrower is actually the parent. So even though the loan is linked to a student who is in school, the parent is actually the borrower, or the person who signs the master promissory note, and the person who's responsible for ultimately repaying that debt. As for the interest rates and terms, with Parent Plus loans, because they're offered by the federal government treats everyone the same. The interest rates would be the same for every borrower. Those rates are set every year. Once you have your loan, that rate is locked in for life, but you know the terms up front because it's the federal government. They state everything on the website. You don't have to worry about, having one rate for 5 years and then the rate jumps up higher. All of that stuff is spelled out for you up front, and it's the same across the board. And also, because Parent Plus loans are federal loans, they have access to certain federal benefits. If you take a look at private loans, the lender is a bank or an alternative lender, not the federal government. The borrower is actually usually the student, but since the students most of the time have no income, no assets, and no jobs because they're in school, a cosigner is required, and that's where a parent might jump on board. But the primary account holder for that private student loan is the student. In terms of the interest rates and the other terms attached to the loan, they could vary with the credit worthiness of the borrower. So for students, generally, they're going to be viewed as, I think, risky by alternative lenders because most of the time they have no income, no job, no assets. And those aren't things that lend themselves to favorable lending terms. So the interest rates could vary, the repayment plans could vary. All of that depends on the individual lender. And lastly, because the loans are coming from private lenders and not the federal government, there is no access to federal student loan benefits. So some questions to consider before you take out Parent Plus loans. The first one is, who do you want to be responsible for the debt? Would you prefer that it be the student, or would you want for it to be yourself as the parent? If you do want it to be yourself as opposed to your student, the next question I would ask is, do you have the capacity to repay the loan? The big difference between Parent Plus loans and private loans is the application process. With private lenders, they evaluate your capacity to repay, taking a look at things like your income, your credit history. With Parent Plus loans, capacity to repay is not evaluated. Your credit is evaluated, but not in the traditional sense of looking at your score. Instead, they're looking for adverse credit conditions, kind of big ticket items like foreclosure, thousands of dollars in unpaid medical bills, bankruptcy, things of that nature, but they're not looking at your score. So with a private lender, they're actually going to be looking at capacity to repay. If you don't have the capacity to repay, you might not be approved as a cosigner. Which brings me to the next question, which is, how is your credit? If your credit is not the greatest, you might still be able to get a Parent Plus loan because they're not looking at your credit score. Again, they're just looking for those major adverse credit history events. Whereas if you're approaching a bank or another type of private lender, they're probably going to dig into your credit pretty deeply, especially if you're trying to borrow a significant amount of money. So really think about who should be the person who's responsible to repay the debt. If you are comfortable being a co-signer, if you're not taking out Parent Plus loans, then what does your credit look like? All of those factors should go into the decision about what type of loans you borrow, or if you borrow at all on behalf of your child. A couple of things I do want to note with Parent Plus loans. The first one is that one parent can borrow Parent Plus loans for multiple children. A student can only borrow for themselves. Okay, a parent can borrow for themselves if they were a student, and they could also borrow Parent Plus loans for their student. I say that to make the point that parents can end up borrowing a lot of money because if they borrow for their own education, they borrow for their child's education, they have another child whose education they borrow for, that tab can get pretty big pretty quickly. Also, there's no lifetime dollar limit on the amount of Parent Plus loans you can borrow. So in the case of regular federal student loans, there's what's called an aggregate limit. For Stafford loans, I believe the number you can borrow up to is $138,500, and that would include your undergraduate education and your graduate education. Once you go beyond that, the only federal loans that would be available to you as a graduate student would be Plus loans. For parents, there is no cap like the 138.5. The only cap that there is the cost of attendance for your student's institution. So if the cost of attendance every year is $50,000 and your student has aid of $15,000, you could borrow for the rest, that remaining balance of 50 minus 15, $35,000. As a parent, you could take that out. And if you take that out every year, you can see how a parent can run up a huge tab pretty quickly. And if they have multiple children, it just swells even more. So whether you're taking Parent Plus loans or co-signing on private loans, you should be very careful because this could be a significant debt load. I know many people have probably heard the student loans are extremely hard to get away from in terms of things like filing for bankruptcy. There are benefits for federal student loan borrowers, but in the end, just think about how much debt you are comfortable taking on and how much debt you have the capacity to repay. Because if you do not repay these loans, it will damage your credit, and that will cause any other lending arrangement you get into, whether it's trying to purchase a car or trying to purchase a home, if someone is willing to lend to you, the terms are going to be less favorable. There could be higher fees or higher interest rates, and that basically makes your car, your home, more expensive. So you really want to be careful before you get into taking out loans for your child or co-signing on loans for your child's education. All right. Next question, we're shifting gears to public service loan forgiveness. The question is, I have 4 to 5 years more to pay to reach 120 payments. Did I have to complete the PSLF paperwork and send it in before October 31st of 2022 for my loans to be monitored for the program? That is an excellent question, because that 10/31/22 deadline had been on all of our minds since it was announced in October of 2021. A couple points about public service loan forgiveness. PSLF actually went into effect in October of 2007 as a result of bipartisan legislation. It's still available, even though the waiver expired on October 31st, and it's also not currently subject to any legal proceedings. So PSLF operates completely separately from the Biden-Harris Student Debt Relief Plan that's currently awaiting for arguments to be heard by the Supreme Court next month. So it's not too late to apply for PSLF. If you want the maximum benefit, though, I would suggest you get your application completed and submitted by May 1st of 2023. Here are the steps you need to apply. The first step is to gather the employer ID numbers for all the employers that you've worked for since October 1st of 2007. Employment after that date can qualify toward public service loan forgiveness if your employer is a qualifying organization. The EIN is something that you can find on your W-2s. You also want to visit studentaid.gov/PSLF and use the PSLF search tool to verify your employer's eligibility. You really should do this first, because once you move to the next step, which is logging into studentaid.gov and beginning to fill out the PSLF application, the first thing they're going to ask you for is the employer ID number, because that's what's used to screen and see if your employer is indeed eligible. So for the employers that you confirmed are qualifying employers, you want to use the online PSLF help tool at studentaid.gov/PSLF to complete your parts of the PSLF application. I say your part because there's a part you need to fill out, and then there's a part that your employers will need to verify, sign, and return to you before you can turn the form in and have it accepted. So once your employer has done that, I highly recommend giving it a once over, just looking to make sure that the signatures are not typed, because typed signatures are not accepted. That can cause your application to get rejected. You want to make sure that the signature is either hand drawn, or it could be an image of a hand-drawn signature. It cannot be typed, even if it's a fancy font. Typed signatures are not accepted when it comes to this program. So after you've given it that once over and made sure that everything, all the boxes have been checked, all the signatures have been made, you want to send that completed and signed PSLF application to MOHELA. The contact information for MOHELA is on the PSLF application. You want to make sure that you send it to them by May 1st of 2023 for the maximum benefit. It's really important that you get that form to MOHELA. They are the one servicer that's responsible for the public service loan forgiveness program. So if they're not your current servicer, sending that form to your current servicer is not going to do anything. You have to send the form to MOHELA. Once they receive the form, if your loans are with another servicer, upon review of that form, that will basically initiate the process of your loan shifting from your current servicer over to MOHELA. After the loans are with MOHELA, then they can begin the process of verifying your employment based on those PSLF applications, and then counting your repayment history to see how much time your loans were in repayment versus how much time you worked for a qualifying employer. And if they look at all of those records and find that there are 120 months of overlap, then you will have met the requirements for public service loan forgiveness. So in summary, no, it's not too late. And if you want the maximum benefit for recognizing your past payments or periods of repayment, then you should submit the form by May 1st of 2023. All right, next question. This is still about PSLF. The question is, my daughter applied for PSLF and she was told 12 of her payments wouldn't count. Does this sound right? I thought the rules were different. So it's true that the rules were different during the waiver, and the rules from the waiver, many of them carried over into this new period that we're in called the IDR Adjustment. The IDR Adjustment is basically a one-time count that the Department of Education is conducting for almost everyone. People who have direct loans and federally held FFELP loans will get a review of their account, and they'll receive a payment count this summer. That will let them know where they stand relative to the 20 or 25-year mark that allows for forgiveness under IDR. The months that a person earns under IDR can also be applied to PSLF. I know there's a lot of acronyms, but basically, if you earn credit for IDR, then that credit can carry over for public service loan forgiveness. So I wanted to share with you the criteria for the months that count for both IDR forgiveness and PSLF for people who have documented work with a qualifying employer. So for IDR forgiveness, any months during which you had time in a repayment status, regardless of the payments made, the loan type, or repayment plan. Also, if you had 12 or more months of consecutive forbearance or 36 or more months of cumulative forbearance toward IDR and PSLF forgiveness. Also, any months that you spent in deferment, except for in-school deferments, and that's prior to 2013. Also, any time in repayment prior to consolidation on consolidated loans. So they're looking at all the loan history, and these rules are much more lenient than the original rules of the Public Service Loan Forgiveness Program. So if your daughter has 12 months that are not counting, I would go back and I would actually go to MOHELA's website, and on the navigation bar, there's a PSLF tab. If you click on that tab, you should be able to go down to the payment tracker. And within the payment tracker, there should be a number there for eligible payments. Click on those payments, and then you can see which months have employment certified and which ones need employment certified. And it could be that they just haven't counted the employment for those months. If the loans were in an in-school deferment, then that would not count. If the loans were in a grace period, that would not count either. But anything that's on this list that you see on this slide here should count. So perhaps they'll review it. Perhaps they already have reviewed it, and those months could count. Big thing to remember is that the months that are credited toward IDR forgiveness will count toward public service loan forgiveness, as long as the borrower provides documentation of matching qualifying employment. The only way to do that is to complete the PSLF application and get it in by May 1st of 2023 so that you can get the maximum benefit of this IDR adjustment. All right, we've got another parent. There are lots of parents in this batch. Okay, the next question is, I borrowed $84,000 in Parent Plus loans for my son who graduated in 2008. I am on an IDR and now owe $110,000 due to interest. At one point, they wanted me to pay $1,800 per month. I'm 64 years old. What can I do to get this under control? So, unfortunately, this happens to a lot of people who have chosen to repay their loans using an income-driven repayment plan. That's what IDR stands for. Sometimes the payment that's required through the income-driven repayment plan is not high enough to cover the interest that's accruing on the debt each month. So you start out with $84,000 in debt. You make your payments on time as promised for now, what is this, 15 years, going on 15 years, and you still owe more than you started out with. And that's because the payments are not large enough to cover all the interest that's accruing and to begin to attack the principal. The good thing is that Parent Plus loans can now get the benefit of the IDR adjustment. So it's not a quick fix. However, it's something that could get you closer to loan cancellation than you are right now, especially for people who work in public service careers. So I mentioned before that the IDR adjustment is a count. It applies to borrowers who have direct loans and federally held FFELP loans. So for this particular borrower, since your son graduated in 2008, you really need to go into studentaid.gov and take a look at your loan types. Because if you have those commercially held FFELP loans, you'd have to consolidate them in order for them to get credit under the IDR adjustment. That's a very personal decision, but you need to know which type of loans you have because that will help you determine next steps. Now, when the IDR adjustment was first announced, parent plus loan borrowers were completely excluded from the benefit of these months that are going to count under the IDR adjustment being applied to public service loan forgiveness, but that has changed. The IDR adjustment will now include parent plus loans, both the kinds that are consolidated and unconsolidated. And that's a big deal because with parent plus loans, there's only one income-driven repayment plan that's available, and that is ICR, known as income contingent repayment. So if you weren't on income contingent repayment, then chances are your payments could not qualify toward public service loan forgiveness. But now they're saying that this IDR adjustment will give credit on the repayment history of consolidated and unconsolidated parent plus loans. The time and forgiveness is just the same that I rattled off to you a couple slides ago, but just to reiterate, especially if you're not on track for public service loan forgiveness, you may be able to get credit toward IDR forgiveness, which will include any month that the loan has been in repayment. Doesn't matter if you were late, if your payment was short, loan type or repayment plan. If you spent 12 or more months consecutively in a forbearance or 36 or more cumulative months in a forbearance, then that time can count toward both IDR and PSLF forgiveness. Any months when the loans were in deferment prior to 2013, outside of the in-school deferment, and any time in repayment prior to consolidation on consolidated loans. As for the way that this is going to roll out, in summer of 2023, you should see an IDR count if you have direct or federally held FFELP loans. If you have commercially held FFELP loans, you would need to consolidate so that you can get the maximum benefit of this IDR adjustment. And then in summer 2023, you would see the actual payment count to let you know where you stand. With IDR, there's actually a cancellation provision baked into those plans. It takes either 20 or 25 years, depending on the types of loans you have and the type of repayment plan that you're in. For this borrower, being that they are already at least 15 years of repayment, this would mean that with the IDR adjustment, perhaps they have 5 or 10 years to go. If this person, worked in public service or is willing to go back to work in public service, then it's possible that they might have already accrued enough time to have the remaining balance canceled through PSLF by way of this IDR adjustment. So I wish I had something that was faster for you, but these are the rules. And right now we've got this IDR adjustment going on that's going to bring everyone to a place where they know if they have direct loans and federally held FFELP loans, they'll know where they stand relative to that cancellation provision that comes along with income-driven repayment plans. And just to review those, income-driven repayment plans have monthly payments that are based on your income and your household characteristics. And they have cancellation provisions after you've made payments for 20 or 25 years. There are several income-driven repayment plans, and the rules are kind of different for each one. So for income-based repayment, also known as IBR, for the original, the cancellation provision was supposed to kick in after 25 years. For new borrowers, I believe those are borrowers who took out loans on or after July 1st of 2014, but I need to go back and verify that. But either way, for new borrowers, that time was reduced to 20 years. With income contingent repayment, the only plan that's available to parent plus loan borrowers, the cancellation of the remaining balance is supposed to happen after the parent has made payments for 25 years. There's another plan called Pay As You Earn. With Pay As You Earn, cancellation is supposed to kick in after you've made payments for 20 years. And finally, there's Revised Pay As You Earn. This is the most recently implemented repayment plan. If all the loans that you're repaying on the plan are undergraduate loans, then cancellation should kick in after 20 years in repayment. If there are any graduate or professional school loans involved, then that period jumps up to 25 years. But the point is, with income-driven repayment, there is a cancellation provision baked into all of those plans. It doesn't matter if you work in public service. It doesn't matter if you work at all. There's supposed to be cancellation with these plans. The issue is the cancellation just hasn't been happening. It hasn't happened because in many cases, loan servicers were not keeping track of payments. So there was no way to know how close or far a person was from having met that goal of 20 or 25 years in repayment. No official tracking of that. So the Department of Education is basically conducting this one-time fix to look backward and address the issues, and then to look forward to make sure that those issues do not continue into the future. So I hope that the IDR adjustment might provide a pathway to cancellation for this particular borrower who has been in repayment on Parent Plus loans for the past 15 years. All right, we've got another question here. It says, I am a senior citizen and I have been an RN for 20 years. I will still be paying on my loans for another 10 years, and I don't believe I will qualify for PSLF. And the question is, are there any resources for me? So we're looking at relief outside of PSLF, and right now the opportunity is the IDR adjustment. However, since you mentioned that you are an RN, you might work for a nonprofit hospital or organization or for the government. So don't rule out PSLF unless you have actually determined by using your employer's employer ID number that the employer does not qualify. So the first thing I would say is look at your employment history after October 1st of 2007, get all those EINs. Since you've been in repayment for all that time anyway, get all of those EINs, go to studentaid.gov/PSLF and find out if any of the employers are indeed qualifying employers for the purposes of PSLF. If PSLF is not an option, then I want you to look into the IDR adjustment, because you mentioned that you were 20 years into repayment and you had 10 left. But with those income-driven repayment plans, cancellation is supposed to come after 20 or 25 years. So depending on the types of loans you had and the repayment plan that you were enrolled in, and really how long you've been in repayment, you might have already gotten to the point where those debts can be canceled. But in some cases, you'll need to take action to receive that cancellation. So here are some steps. First step is verifying your loan type. Are the loans direct or not direct? Since you've been in repayment for 20 years, there's a strong possibility that those loans are not direct. But if they are direct, you wouldn't need to consolidate them to get a count through the IDR adjustment. If it turns out the loans are FFELP loans, you'd have to consolidate those if you want to benefit from public service loan forgiveness. So if you use those EINs and found that your employer is a qualifying employer and you have FFELP loans, you'd have to consolidate them anyway to benefit from public service loan forgiveness. Lastly, if the loans are FFELP loans and they're commercially held FFELP loans, you have to complete the consolidation application by May 1st of 2023 to get the full benefits of that IDR adjustment. And remember, months that are credited toward that IDR adjustment can count toward public service loan forgiveness. And that's, again, if you have the qualifying employment. After you verify your loan types, the next thing you need to do is consider your repayment options. IDR cancellation takes a maximum of 25 years in repayment. If you're looking at 10 more at this point, then this would speed things up for you. However, for your future payments to count toward this IDR forgiveness, you have to be enrolled in an income-driven repayment plan. If you haven't been enrolled in one, you should use the loan simulator at studentaid.gov to estimate your payments and see if there are any income-driven repayment plan options that are affordable enough for you to switch. And if you find that the payments are affordable, you would enroll in an income-driven repayment plan to make sure that your future payments are counting toward IDR cancellation. But with 20 years in repayment already, you could have reached the mark already for cancellation, or you could have maybe 5 years to go on this IDR cancellation path, but it really depends on your loans and how you've been going about repaying them so far. So very personal situation, but from my view, you are closer to the end of this journey than you are to the beginning of it. And remember, the time toward IDR forgiveness includes any months in which you had time in a repayment status. Doesn't matter if the payments were late or short, if you had the wrong loan type or repayment plan. Also, those lengthy forbearances, 12 or more months consecutively or 36 or more months cumulatively, all of those can count. Any months spent in deferment outside of in-school deferments, and that's prior to 2013, and any time in repayment prior to consolidation on consolidated loans. So if you had FFELP loans or commercially held FFELP loans and you consolidated them, the IDR forgiveness would allow you to receive credit for the payments that were made on the original loans before they were consolidated. So the clock is not resetting to zero, and that is a huge benefit. All right, we've got another question about PSLF, and that's, I missed the 10/31/22 deadline to apply for PSLF. The question is it too late to apply? The answer is no, it is not too late to apply. The waiver did end as planned on October 31st of 2022, but some of its provisions are continuing through the IDR adjustment until May 1st of 2023. I know that I'm saying this over and over again, but this is really important, especially for people who have been in repayment for at least 20 years. Time toward IDR forgiveness includes the months when you have loans in a repayment status. They're not actually looking at the payments, they're looking at the repayment status of the loans. Lengthy forbearances, because you're not supposed to get more than 36 cumulative months of the forbearance over the life of any loan. So all of those lengthy forbearances, 12 or more months consecutively, 36 or more months cumulatively, can count both toward income-driven repayment forgiveness and forgiveness by way of PSLF. Months spent in deferment prior to 2013, with the exception of in-school deferments, and any time in repayment prior to consolidation on consolidated loans. So if you have been in repayment on loans for at least 20 years, your debt could be forgiven this spring. The people who have already met that requirement of 20 or 25 years are supposed to see their debts canceled automatically this spring. For people who have a longer way to go over the summer, you should receive a payment count. That's if you have direct loans and federally held FFELP loans. If you have commercially held FFELP loans, and there's that extra requirement that you consolidate by May 1st to get the biggest benefit. But again, consolidation is a very personal decision that you'll need to evaluate after looking at your loans and repayment options. Oh, and here we go. Next question, which is, should I consolidate? I have FFELP loans from 2006. How many months will I get credit for on the IDR adjustment if I consolidate? What a fitting question to have here. Okay, so let's talk about consolidation. What consolidation does is it usually takes more than one older loan, pays those loans off, and originates a new loan for the sum of the older loans. But if you have just one old loan, you could consolidate that too. It doesn't need to be combined with another loan. The purpose of consolidation for many people is so that one, they can gain access to different income-driven repayment plans, because those older FFELP loans don't have as many options. Second is so that people can begin making progress toward public service loan forgiveness, because FFELP loans don't qualify for PSLF. However, under normal circumstances, if a person consolidates their loans, all of their past repayment history is ignored for the purposes of public service loan forgiveness. So it wouldn't matter how long you've been in repayment. If you consolidate those loans, you're starting over at payment number 1 for the purposes of public service loan forgiveness. Second is that a new repayment term begins. So you basically reset the clock, not just for PSLF, but for repaying the loan. So if you've already been in repayment for 15 years, you consolidate and start to repay again. You're again starting off with payment number 1 on what could be a 20, 25, or 30-year repayment term. Third is that going forward, your qualifying payments and qualifying employment can count toward PSLF, but it would only be looking forward, not backward. So in this situation here, we have a borrower that has a Grad Plus loan with 70 months of history, a FFELP loan with 204 months of history, because these loans are back from 2006. If this person consolidated these loans under the normal rules, they have a direct consolidation loan with 0 months of credit toward public service loan forgiveness. And that right there is enough to make some people say, you know what, I don't want it because I have 0 credit. If I want PSLF, that means that I have to work and make payments for at least another 10 years. I don't want to start over, I'll leave it alone. However, the rules of the limited waiver changed that. They allowed for people to consolidate loans and have credit for their past payments applied to PSLF. So the borrower could consolidate to gain credit for past payments that would have been previously ineligible for PSLF. And then all the loans, in this case, we had a Grad Plus loan with 70 months of history, a FFELP loan with 204 months of history. Those loans will be placed on the same repayment clock. And there's an asterisk there because one condition of the waiver was that if you had these loans taken out at different time periods, then when they're combined, the combined loan, the new consolidation loan, will receive credit for the number of months attached to the loan with the greatest amount of history. And I see I have a typo. Please pardon this typo right here that says 210 months. We have a loan with 70 months and a loan with 204 months. If those loans are combined together, that would give the consolidation loan credit for 204 months. I'm sorry, not 210. But this is assuming that that rule of the waiver around consolidating loans with different repayment histories is going to stand throughout the IDR adjustment. I've heard that it is. I've heard some people say it appears it's going to continue through the IDR adjustment until May 1st of 2023. I haven't seen it stated within the guidance from the Department of Education, but I've heard from some sources that I consider to be reliable ones that this is what's going to happen. So if that part makes you uncomfortable, I would hold off on it and see if the department issues some type of clarifying language, and then you have until May 1st to go ahead and make your decision. I also will be asking borrowers who have done this, who've consolidated during the IDR adjustment period, to see what their accounts look like so I can report back and tell you what's actually happening. But for this person, we've got the old loan, 204 months, the more recent loan with 70 months, put them together and correct this typo here. It will be 204 months. Now, 204 months is more than the 120 that's required by way of PSLF. So if this borrower earns the full 204 months of credited history through the IDR adjustment, and they've been working for a qualifying employer the entire time, then they have exceeded that requirement of having to have qualifying payments for 120 months. And if they've done that, that means the remaining balance can be cleared by PSLF. Again, we've got one loan with 70 months, one with 204 months, put them together, that's 204 months, not 210. But regardless of that small error, the key here is the number of qualifying payments on that consolidation loan is greater than the 120 payment requirement of PSLF. So in this example, you can see how a person could consolidate these loans to gain credit toward both IDR forgiveness and public service loan forgiveness. Key to remember here is that in the original scenario, if we go back to consolidating under the original rules, you have one loan with 70 months of history, one loan with 204 months of history, put them together, you start at 0 in terms of PSLF. So the waiver made a huge difference, and it appears that the treatment of consolidation loans that we saw during the waiver will continue through this IDR adjustment until May 1st of 2023. As for the rest of this and how it rolls out, in the spring of 2003, borrowers with loans that have accumulated time in repayment of at least 20 or 25 years will begin to see automatic forgiveness, regardless of their enrollment in an IDR plan. That's pretty big. Beginning in July of 2023, all borrowers who have direct and federally held FFELP loans should see their accounts updated with a count to let them know where they stand relative to that 20 or 25-year milestone. If you have commercially managed loans, that could be commercially managed FFELP loans, Perkins loans, HEAL program loans, or other non-direct loans, you need to submit the application to consolidate by May 1st of 2023 to get the full benefits of this one-time account adjustment. That's if you decide that you want to pursue cancellation via IDR. If your loans are in default, you can still benefit from this program, but you need to get out of default before July 2023. So I would highly recommend reaching out, actually taking a look at your account in studentaid.gov, contacting the default resolution group, and getting on track for that fresh start so that you can get out of default and have that pathway toward the zero balance. Before I go, I'm going to go a few minutes over because I started a few minutes late. So before I go, I just wanted to share with you some options for accountability if you're having difficulty with your servicer or your lender. First is the Consumer Financial Protection Bureau. You can visit them online at consumerfinance.gov. Also, the U.S. Department of Education's Ombudsman can help with specific concerns around federal student loans. You can visit them online at studentaid.gov to review a list of those concerns. And if your concern is about public service loan forgiveness, there's an option for you to submit a reconsideration request so that your account is reviewed. Also, the state of Maryland has a student loan ombudsman that can help you with problems that arise from your student loan servicing experience. Those problems include failure by the servicer to communicate with the borrower, errors in crediting principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidations or modification errors, and or inappropriate collection activity or tactics. And you can visit the Student Loan Ombudsman online at the Department of Labor's website if you are currently in loan repayment and have a complaint about your loan servicer. Maryland is also a state which has a student loan borrower's Bill of Rights, and you can view that Bill of Rights also via the Department of Labor's website and learn more about the protections to which Maryland borrowers are entitled and the obligations of student loan servicers. And finally, before I go, I just wanted to share with you some of my favorite resources. One, of course, is the Office of Federal Student Aid, because if you have federal student loans, that's where they come from. You can visit them online at studentaid.gov. If you need to do things like complete the PSLF application or complete the application to consolidate or determine loan types, that is the one place where you can do it all. You can do it for free, online, by yourself, virtually anytime. That's at studentaid.gov. Secondly, of course, I have to recommend the Maryland Center for Collegiate Financial Wellness. We launched a campaign last year called MD Taps, which is Maryland Tell a Public Servant, to spread the word about public service loan forgiveness and the limited PSLF waiver. Even though the waiver has expired, since so many of its provisions are continuing through the IDR adjustment, we have updated our page to acknowledge the waiver, but reflect more information about the IDR adjustment that's happening right now. So you can visit us online at mccfw.org/mdtaps, and please do share that information with anyone that you think might be interested in it or could benefit from it. I also like the Institute of Student Loan Advisors, freestudentloanadvice.org. They have, their founder has created a PSLF mega thread, which has so much information about public service loan forgiveness therein. And there are borrowers all over who are contributing to this conversation and talking about their real-time experiences with applying for public service loan forgiveness. There's also information about student loans in general and the IDR adjustment. And you can visit them outside of Reddit online at freestudentloanadvice.org. Lastly, the Student Borrower Protection Center has put together a site. It's cancelmystudentdebt.org. And the site does a very thorough job of breaking out the options for forgiveness, whether you're looking for public service loan forgiveness, the Biden-Harris Student Debt Relief Plan, or relief through the IDR adjustment. They have lots of resources there to show you step by step things to consider and what to do depending on your loan types and your situation. So please do take a look at all of these. If you are interested in one-on-one advising, I take a limited number of clients each month for free, thanks to partnerships with organizations like the Howard University Small Business Development Center. It's the DC Small Business Development Center, lead center on the campus of Howard University, as well as Cafe Montgomery, which is the Financial Empowerment Center for Montgomery County. And partnering with those organizations, I'm able to provide advising hours for student loan borrowers free of charge to the borrower. So if you're interested in that type of one-on-one advising, please do visit mccfw.org/contact. Fill out that contact form and I can send you the scheduling link so that we can take a look at your loans in a more personal setting and review all the options that are available to you. And also, please do check out mccfw.org/mdtaps for additional information about the IDR adjustment, because there are many people who could stand to benefit from this, and some of them will need to take action by May 1st of 2023. All right. It is 8:05. I thank you so much for joining me for this edition of Office Hours. I'm just looking at Facebook and I see that my Aunt Linda is watching. Love you, Auntie. And I will be back with another edition of Office Hours in February. Before I go, I did want to say that we take these videos and we upload them to YouTube and we annotate them by questions so that people can get to the content that is most applicable for them. So within a couple of days, look for this particular video to be uploaded to YouTube so that you can, again, take a look at that table of contents on the video and get access to the questions that are of the most importance to you. So thank you again for joining me. I hope that you've had, you found use and help in the information that's been presented. If you need more, reach out at mccfw.org/contact. Also, connect with us on social media at the MCCFW and on Facebook, the Maryland Center for Collegiate Financial Wellness. Until next time, my name is Dr. Tisa Silver Kennedy. Be well.